the picture? Well, interestingly, you had a high at this point in, you can see, well, I'm on the hourly now. You had your previous high locally Friday 19th, end of last week. And then if you go slightly further, you peaked at 75. And then before that, going into December, your last peak was here. So what's happening is you're slowly getting these lower highs, and at the same time, you're getting higher lows. Okay. But generally, the market is just going sideways. Okay. And it's doing that because it's unsure, doesn't know whether it wants to go up, okay, and be propped up by firm pricing, doesn't know if it wants to go down. And what's happening is it's going sideways. Now, this is great for people like myself, because people like myself will take a very big advantage. And my co-mentor has been posting about oil longs constantly. He's been drilling them. I've been trading it short. He's been trading it long at the bottom, sorry. And we're basically both taking each side of the market. I'm shorting it because I don't want to add any longs lower. He's not shorting it because he wants to add longs only. Okay, but it doesn't matter what happens. That's the key thing, because on this spectrum of price going sideways, you can take gains over and over and over again. Now, that's brilliant, not just because you'll make more money, but because it allows our method to work. We know if we longed it sort of, let's say, up there, okay, over here, and we're now wrong, all the money we make here is going to allow us to get rid of that and be in profit. Okay, and we do that through a cyclical process over and over and over again. Now, that's how we trade. Of course, there's a lot more to it. But if you look previously at how this sort of works generally for oil, we peaked up here. Okay, you had lots of fears regarding energy, and you spiked up. That came straight off the back of this enormous drop. So you saw the biggest two extremes almost, really. I mean, you didn't fall to zero here, but you didn't rise as high either. You saw these extremes when there are extreme conditions, okay? Financial crisis, where I'm labeling now. And then you had, of course, COVID, and then into the energy crisis that followed because of inflation, things like that, war, all those kind of things. Now, what you're getting at the moment is a lessening of demand, which is why supply is going up and why the price is subdued. Lots and lots of people are saying the same thing. They say, okay, well, there's a tax in the Middle East. Why isn't that pushing the price up? Surely that's going to limit supply. Well, the obvious answer, I'm afraid, is it's not that hard to work that out. The truth is, if that was the case, it would be priced into the market. The fact is, price always reflects what's going on in the world. Sentiment is necessary to track because it tells you the inherent risk of the market. It tells you how dangerous that event is, and therefore you can change your size. That's why we keep track of it all the time. But you can see the sentiment around this is sideways because you have got those rebel attacks, but you've also got things like, supply side impetus regarding China. I mean, you can look all this up on the internet in a Google search. You could put crude oil, price today news, and it will tell you exactly why this is happening. All right. So if you're wondering why it's not rising or not rising yet, it's because there's still supply side coming in. All right. And when you've got a higher supply, there's less demand, the price drops. So that's what's happening now. You don't have a high demand, you don't have a high supply. All right. And what's happening as well is you're coming off the back of significant demand. And that has been waning and waning and waning. And the reason why you get a downtrend, therefore, is because waning demand equals increasing supply equals lower prices. Hence the fall. Okay? So that hasn't stopped yet, clearly, because if it had, you would have gone to the upside. Now, what I tend to do is I lessen my risk on the long side, which is why I haven't been buying it. Because I know there's a good chance eventually it could fall through. So I don't want to take that risk. On the other hand, I also know that I can trade it very lightly up here at key price action, which I'm more than willing to do because the sentiment is in my favor. There is no demand side bias. So every single time I've shorted it on a rise, I've been able to get out for gains. Okay. So the bias at the moment that would take, and I've taken it for a long time, I wouldn't be entirely shocked if ultimately you do get down here. Okay, I also wouldn't be shocked if the price completely reverses and goes the other way. All right, because like I said, you've got mixed sentiment here. You're not clearly falling in. You haven't got clear supply side or clear demand side. That's why it's going sideways. Okay, that could change at any point, and often after the market goes sideways for a significant period of time, that's when you do finally get the change. Okay, you get that added force, if you like, to push the price all the way up or push the price all the way down. Okay, so you're awaiting that basically. Now, if you were planning new shorts, you could consider not shorting here, but rather shorting at the upside. That would take you nearer to $80 per barrel. Okay, so that's where I'd look short on oil if you get a rise. Particularly for myself, I would rather see oil come much lower. Okay, if I was to buy it, and I would reflect plainly off higher time frames for long side entries. Okay, so for example, if I swap to my monthly and drew an eclipse all the way out, you have got your first level in line with former support. Okay, that could be entry 1, for example. But then if you're more risk averse, I really wouldn't be surprised if that candle wick doesn't hold and you end up coming lower. And then at that point, you'd be in line with your key, I believe that is your 100. You'd be in line with your key 100 moving average SMA on your monthly chart, which obviously is a key technical zone. So if you're an investor in oil, I would just let it do its thing slightly, is pretty much what I'm saying. That means falling through former levels where you've had reduced impetus and some level decay. I think there's still a lot there left to be taken, $63.60. Ultimately, though, wouldn't be surprised at all if we end up coming all the way down here to better levels. So my bias, I would consider perhaps holding off shorts at the top of this channel, like I said, if you're risk averse and going for $77. And then if you're a risk averse long side trader, it needs a thump. But if you do get sudden increased supply, like I said, or some news, which normally does happen after you've had a sideways market for a significant period of time, remember you can hedge all this with our method for long-term gains, and then I would consider entries. So that is oil. If you're just coming in, do not forget to press the like, and my live room, we're going live at noon today. That's 2 hours, 20 minutes. We're covering all charts, all entries and exits we're taking. So that's oil. Let me go for something else. What should we go for? Should we try FX perhaps? Maybe you could update on the yens. Everything's a bit stagnant today because there isn't increased impetus via news. You don't really have any news today, but it does give us a chance to analyze markets for the week going forward so that we can see really where we're heading before we start to